Inflation has come down substantially since last summer, but it is still too high. And by some measures, progress has been decelerating. While it is reasonable to expect that the recent banking stress events will lead banks to tighten credit standards further, the amount of tightening and the magnitude of the effect such tightening might have on the U.S. economy is not yet clear. And this uncertainty complicates economic forecasts. Short-term interest rates are 5 percentage points higher than they were a little over a year ago. History shows that monetary policy works with long and variable lags, and that a year is not a long enough period for demand to feel the full effects of higher interest rates. While my base case for the U.S. economy is not a recession, higher interest rates and lower earnings could test the ability of businesses to service debt. In addition, and perhaps more in focus given recent stress events affecting certain areas of the banking sector, higher interest rates could further exacerbate stress events at banking organizations, especially those that are highly exposed to longer duration assets and have a relatively high ratio of uninsured deposits to total deposits. Since late last year, the Federal Open Market Committee has slowed the pace of rate hikes as we have approached a stance of monetary policy that will be sufficiently restrictive to return inflation to 2% over time. A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Indeed, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming.